I'm inclined to believe that we are in the midst of a bull run here. How high it goes, I don't know. Some people are talking 2,700, 2,800, maybe even the psychological barrier of 3,000. But I do think that people who are waiting for a pullback, it's too late in the game to do that. I mean, it is, maybe. I mean, it seems that way to me. So instead, the better way to do it is to cost average. And if you have an amount to spend, instead of waiting for a pullback, divide it into 4 and buy every week or every 2 weeks, or increase your purchasing if you feel you have to. But waiting for that pullback could be something that keeps people waiting for a very long time.
And now they're in a rush to stop quantitative tightening. Why? You happy? Are you happy with inflation rising at 3.5? Now, I did go to school and did take a lot of math classes. So is 3.5% higher than 2? It's a lot higher than 2, right? So why are we looking for reasons to cut interest rates? And why are we looking for a way to get out of quantitative tightening when inflation is way above your target? And like I said before, prices need to fall, not go up more slowly from an unaffordable level. That's the truth.
In today's episode, 2 financial experts, Andy Schectman and Michael Pento, talk about the recent price action in gold and silver as the metals bull run continues. We watched hours of their content, so you don't have to. So we bring you a compilation of the best clips of these 2 experts discussing the latest main macroeconomic fundamentals of the precious metals markets and their insights on how they are positioning to capitalize on what's to come. Later in the episode, we also share with you the most relevant news of the day. So we keep you informed. Smash the subscribe button, hit the like button, and share this video with a gold bug as more people need to know. Enjoy the episode.
This is something that I think is worth contemplating. Are the Chinese really turning up the heat? There's been a lot of articles lately talking about the May contract and the deliveries and the shorting. And it's interesting, what I have taken away from it is that HSBC Bank, either for their house account or by proxy for one of their clients' accounts, has been shorting the price of gold, but we've seen tremendous amounts of exchange for physical move to China, and there is a Brinks facility in Hong Kong that is part of the COMEX ecosystem. And a week ago Friday, we saw 243,000 ounces, over $571 million worth of gold that was delivered in that direction. And anything that ends up going to Hong Kong, just about all of it to Hong Kong Brinks, is exchanged for physical. And we're seeing the price be knocked down on the Western exchanges, and then contracts bought in the OTC market for exchange for physical for delivery in Hong Kong. And the theory is that there are trucks picking that up and bringing it right over to the Shanghai exchange, which is aiding in the delivery of metals like we're seeing here, up 200% in the past couple of months. When we started talking about these things way back when, Dunnigan, in 2020, we talked about the rise of the others, these people that were bleeding dry the markets. But you can only do that so long before you start to get on the radar screens.
Because I happen to think that Japan is dumping gold and dollars to prop up their currency. They're dumping treasuries, which are dollar denominated, dumping those, buying the yen on the FX exchange. I think they're dumping gold too. And for days like today, where I saw the yen was very weak overnight, and then you say, well, why is gold down today? Interest rates are down and the dollar's down. Shouldn't gold be up? But I think the bank. That's my theory. I can't prove it, but people say, what's the big deal if we become Japan? Japan's nice place, nice island nation. But when you think about it, Japan's a train wreck. The Bank of Japan is the market for JGBs, Japanese government bonds. Without that, there is no market. They don't trade.
Of my career, if you look typically when the ETF participation falls the way that it is, typically the price would fall with it, yet it's going higher. When you look at positive real return on the treasury market, usually the price of gold would fall. It isn't. When you look at a dollar as strong as it is on the dollar index, usually the price of gold would fall. It isn't. The demand from the central banks and the big money in China and India and Russia and these countries that are doing what we just talked about is strong enough not only to put a floor under the price of gold and silver, to give it resiliency when it gets smacked down by the naked shorting of the Western commercial banks. But at the same time, we're seeing massive physical demand by the public in China, where the demand for their ETFs are triggering the breakers on the upside because the demand is so high. And we've seen really a lot of selling. In fact, it surprises me how much selling we have seen into these rallies in gold and silver by the public. The only thing that really is becoming harder to get and showing us higher premiums have been silver eagles. And maybe that's a precursor, but everything else I would say is ridiculously undervalued.
Andy Schectman highlights the latest trends in the precious metals market. Recent technical analysis reveals a significant breakout in a 12-year cup and handle formation, signaling a bullish forecast for precious metals, particularly as global demand spikes, with substantial shipments to the Shanghai exchange. Meanwhile, physical availability is tightening. Silver eagles, for example, are seeing increased premiums, suggesting that silver is currently under-owned and undervalued. This shift underscores a larger global trend as countries increasingly move away from U.S. treasuries in favor of commodities like gold and oil, reflecting a growing distrust in traditional financial systems and anticipating continued inflationary pressures. Investors are advised to consider a long-term perspective, regularly investing in precious metals as a hedge against economic instability. Like, subscribe and share this video with a silver bug because more people need to start stacking. Now, let's get back into the episode.
If the Federal Reserve came up and said, our goal is to be the banker's bank, and we care about keeping bank liquidity functioning smoothly, that's really our primary goal. And then by doing that, they have a tool. It's a fiat currency. It's not backed by anything. It's unfettered with the price of gold or tied to it in any way or any commodity. It's not tied to GDP growth. It's not tied to productivity growth. It's not tied to population or labor force growth. It's tied to one thing. What do these 12 apostles, the 12 voting members of the Federal Open Market Committee, what do they think? That's what it's tied to. And so what they say, their calculation is, well, banks will go under and we'll have a depression if we let asset prices fall to where they should be, where they can be supported by the free market. Can't have that. So we're going to pretend that we care about the poorest among you. But if they did, then wouldn't they just look at the Wall Street? This is not my numbers, the Wall Street Journal, and they undercounted it, a 37% increase in food prices. Nobody's income. Nobody. A very, very small percentage of the U.S. population has had their incomes increase 37% over the past few years. And as a matter of fact, if you look at the BLS data from the non-farm payroll report, a lot of people are losing we're creating part-time jobs and losing full-time jobs with benefits and higher wages. So there's a cogent argument to be made that, your incomes are flat. They're skewed to the wages and incomes are skewed to the higher end. The top quintile is doing fine. The lower four are getting wiped out. 78% of Americans are living paycheck to paycheck. I think some 60% of them don't have $1,000 in the bank. And that's a success. This never would be remotely possible if we didn't have 100% fiat currency. And the Fed didn't think they had a tool. I said, wait a second. Why do we have to live in reality? We could just print money. And every recession and every bear market can be monetized away with our tool. Isn't that wonderful? That's the truth. Then again, that's why I come on shows like yours, because you get the truth. The truth is that when you were able to untie your dollar, or whatever nation, Zimbabwe, Argentina, Hungary, Germany, whatever nation pursued that path, and they've done, various times throughout history, of just saying, hey, let's just print money to keep interest rates from rising and buy our debt. And that always gets out of control, and that always leads to hyperinflation. So you say, well, and some people say, well, that, Mr. Pento, that could never happen in the United States. Why not? Do the laws of economics not apply to the United States of America? Oh, because we're the world's reserve currency, but we're losing that. But Rome had the world's reserve currency, the Roman Empire, and that caused that still didn't prevent inflation from going to 1,000% per annum in Rome. It can happen. If it happened in Rome, the only world power there was in the known world, it could happen to the United States.
Maybe that's why we're seeing such great strength. It's interesting, they try and knock it down, whoever they is. They try and knock it down. Maybe Bank of America, who's got this wickedly large short position of roughly 1 billion ounces of silver on COMEX and 40 million ounces of gold on COMEX, according to Ted Butler. Obviously they have a vested interest in mitigating its rise, but it comes right back up. And because a lot of this, Dunnigan, has to deal with the fact that these countries, even a few years ago, were not sophisticated or wealthy enough to do this, but in concert. And I think over the last several years, not only in concert are they doing this together now, but the sophistication, the wealth, the understanding of what's happening, they're beating us at our own game, whether it be exchange for physical, by first shorting the paper price, and it appears to be HSBC Bank, shorting the paper price and then standing for delivery on the OTC market with huge amounts of gold, and or India importing 500 million ounces of silver, which is right now, according to the COMEX registered category, is, there's only 300 million ounces in registered and eligible combined, only about 45 million ounces in registered. Those are the bars backing the contracts. India's imported more than the entire COMEX ecosystem and 11 times more than the registered category. But that doesn't count what's happening on the Shanghai Exchange, and so these countries who understand what's going on have been accumulating and repatriating, and now they're slowly turning up the heat, because if they turned it up too fast, I think it creates a problem. I think if they sold their treasuries too fast and tried to arbitrage too fast, because ultimately I think that's what happens. I think ultimately at some point you will see Moscow or Dubai or Shanghai, they'll say silver is now $60 an ounce and gold's now 4,000 an ounce. And just like that, everything would arbitrage over there and the price would gravitate to it. These are the countries that produce it. These are the countries that accumulate it. And these are the countries that understand there is a pivot moving away from the dollar, with a large portion, certainly of the Southern Hemisphere, viewing gold and oil as a safer play, one that cannot be confiscated or sanctioned against them the way that it has been against several other countries, as we've documented well. So I think you will continue to see arbitrage opportunities here, because look, there aren't a lot of traders out there who have the sophistication and the ability to access these markets. So it's the commercial banks and whatnot, but who knows when they turn it up even higher. But it has been consistent with silver now for well over a couple of months, and we don't see any sign of it slowing down. Gold, that spread is a little tighter right now.
What do you think of Pento and Schectman's take? Do you think it's wise to accumulate more gold and silver at these prices? Or would you rather sell your stack and raise cash for the looming recession in the United States? Post in the comments section your honest opinion, and watch this video right here, because it's a perfect fit for you. I see you on the other side.